there's a lot going on in the world today, a lot going on in the economy, a lot going on in the markets, and I'm hopeful that we'll be able to set some good context for all of those issues out there. So there's going to be three parts to the presentation today. The first part is the market strategy, and I'll remind everyone of the four key themes for 2025 that we've been talking about all year, and I think that list will look a little bit prescient given what's going on right now in the markets. We're going to do a Q3 market recap. The headline there is, did we mention AI? Because of course AI is something we've been talking about for 3 years straight now, as has the financial media, especially in the past year. Have some interesting information to share with you about that. And then lastly, the market outlook. The headline there is history rewritten. And I'm going to go back and take apart some of the data that we've all had to rely upon over the last few years to judge where we were at in the economic cycle, to make predictions about the markets and show you what's actually changed. So as the saying goes, history is not what it used to be. So let's go ahead and jump into the market strategy. And we have been starting every year for the last 5 years now with some key themes for the year. And the first one was brace for a tech crypto crash. We actually got a tech crash, if you want to use that word, in the first quarter, but then things have come back. Now, I'll let you know that tech has not been faring so well as of late. So there's more pressure there. And now crypto has joined that, and the overly leveraged asset categories there are at particular risk if there's a shock to the economy. Of course, it's time to diversify, but we don't just mean within the public market because it's so concentrated. We mean within private markets. Most folks on this call will have heard me talk about my favorite asset category. Private credit is a great way to diversify because with 30% of the U.S. stock market and just 7 stocks, even indexing does not mean that you're diversified these days. Financial planning is critical. We talk about looking for hidden and unnecessary risks. And in many cases, as we brace for a potential continuation of the recent volatility, let's remind ourselves that sometimes the best thing about a financial plan is they can find out that we'll be very successful in terms of our expected investment returns by taking on less risk. And it's always nice when you can parse down the amount of risk that you're taking. And for many people, that means they can sleep at night. Lastly, safer assets can be productive. We have a lot of assets here invested in short-term treasury strategies. It's a great way to have money sort of set aside, if you want to think of it that way, in a different bucket, perhaps. If you're going to plan to spend that money in the next few years, or if you have a sudden windfall, an exit from private equity, an inheritance, a bonus from work, something like that, and you just haven't had a chance to meet with your personal wealth advisor to decide what to do, putting that in our short-term tactical treasury strategy is a great way to just keep that away from market risk. And we can actually beat the rate of inflation still, even with rates having dropped. We're ahead of inflation, so it's still a productive strategy. Jumping into the market recap, did we mention AI? I want to move to a slide where the headline is, are we being fooled by the AI provider boom? And some of you may have seen this graphic that's been going around social media, but let me be really clear about our terms here. The AI provider boom is a very specific reference to the firms that are in many cases spending billions or hundreds of billions of dollars to develop AI. It is not referring to the firms that are using AI. And I've spoken about this. I started talking about this actually 3 years ago when ChatGPT entered the stage, and wondered about where might be the long-term payoff. Would it be with those firms that were providing AI? Because if past history serves as a useful precedent, we know that many firms competing in the provider space will fail. And we've wondered about perhaps a rotation into the user space within AI, which more and more, I believe, will have to be every single corporate entity out there. I think it'll be hard to survive and compete without using AI, but it may be that the users are really the long-term beneficiaries and where the best public stock market performance is going to come from, not with the providers, because again, I think there's going to be a big shakeout. And what you see in this graphic is this financial relationship between many of these big names that you've heard of. There might be a few in there that you haven't heard of. But just to give an example, many of you know that Microsoft has invested heavily in OpenAI. OpenAI is the maker of ChatGPT. OpenAI has made investments in NVIDIA. NVIDIA then sells chips back to OpenAI and others to run the data centers. And so you have a lot of money going around just between all these firms. NVIDIA sending money out to a lot of different places, and then that money coming back to NVIDIA to buy chips. And so there's a question of how much true net investment there is in AI and how much is just these big firms just moving money around, which inflates values and inflates revenue and inflates profits until the music stops playing. And just to issue a cautionary note there, if you think about OpenAI, they have revenue uh, of, it's a little bit debatable. There was a contentious call from Sam Altman recently. Is it 10 billion? Is it 20 billion? It's not much. How do you support a valuation that's well into the hundreds of billions or potentially trillions? How are they going to go out and spend hundreds of billions of dollars when their revenue is in the tens of billions? And so it is operating at a severe loss. And many firms here, without the support of their other AI partners, might find themselves in a similar situation. So it's not a great situation if you're counting on these values. I'll also just offer the thought that many of the valuations that we're seeing for the publicly held companies would suggest that the economy is going to grow, that our GDP is going to grow at a rate that is well beyond any kind of estimate that I've seen. Most economists expect that GDP is going to grow at a percent or two above the rate of inflation. So real growth of 1.5% to 2%, nominal growth of 4% to 5%. And these valuations tend to suggest, depending on the timeline you're looking at, that GDP might be having to grow at 7 or 8%. And that just doesn't seem likely. So, one possibility is that the stock market, with 30% of the assets in just seven of these stocks, might be overvalued by 20 to 30%. So, we saw the market start to think a little bit that way yesterday, and we'll see how today finishes out. If we look back to the performance results that ended September 30th, we see that it was a terrific quarter. The global equity index was up almost 8%. Even the fixed income index did surprisingly well. The 1 year numbers have the equities at 16.79%. But if you really want to see the effect of the AI boom in valuations, you'll see that over the last 3 years, where the global equity index has averaged about 22.5% per year for the last 3 years. Now, anyone that's a student of long-term market movements will suspect that that's probably a very unsustainable rate of growth. Even the last decade at 11.63% per year is well above the 8 to 9% that we use in our financial planning. But I will comment that 10 years ago, many of us were reading the headlines about the new normal, where a lot of market commentators, well known voices in financial media, were suggesting that 8 to 9% wasn't feasible, and we all needed to get ready to live with 4 to 5% in the stock market. So, what a great decade compared to what we were all told to expect, but maybe just a little bit too hot, something that I think could be subject to a correction at any time. I included this slide without honestly a whole lot to say about it, but I wanted to include it to contrast it maybe with what I've said in other quarters. So for folks that have watched this webinar before, you may recall that in many cases, I will put the positive news items throughout the quarter in green, the negative news items in red, and by that I mean positive and negative in terms of how they affected the stock market. But I didn't put any of them in green, and I didn't put any of them in red because I wanted to illustrate the point that this quarter, and to some degree over the last 3 years, the market has not cared that much about tariffs, about the war in Ukraine, about even to some degree interest rates, about changes in the tax code, about all these other things. It seems as if AI is the only thing the market cared about. And so for this last quarter especially, the market was moving up no matter what. It didn't seem to care what the headlines were. Now, I don't think that will always be the case, but I wanted to illustrate the point graphically here that AI has been the only news that has mattered. And if in fact we look back and decide that we were in a bit of an AI bubble, then I think the market will start to care again about these fundamental issues. I always like to be able to show all green arrows when we begin to break down the market into its constituent parts. The riskier parts of the markets on the left were all up, and even the fixed income part, where we're starting to see cracks here and there emerge, was up. I'll point out that emerging markets were the best place to invest if you were a diversified investor, or particularly if you were an indexed investor, which is not how we invest, but it's useful to understand where the best parts of the market were. And I think a lot of folks would be surprised with that, because for much of the last decade, we've seen some lagging performance from emerging markets, but this certainly proves the value of being a little bit more diversified outside of just the seven big names in the U.S. stock market, because emerging markets did terrific, even in a quarter where the dollar strengthened a little bit. If we rank the United States across all of the big economies that we can invest in, both developed and emerging, what we'll see is that the US was in the top half. We did a little bit better than the global average, nowhere near the best performing countries, and rarely would it be the case that the US would be the best performer, although the US has had great long-term performance. What you can see with the top names, Egypt, Peru, China, Colombia, South Africa, and so on, is that those were in fact those emerging market countries that helped that index to post the best returns for the quarter. Within the US, some more unexpected returns, in so much as they're inconsistent with the stories that you might be hearing in the press, and even inconsistent with what we have been seeing over the last 3 years. Small cap value did the best, and our clients in many cases are aware that our public market investing strategy is to overweight small cap and value by a bit, because over longer periods of time, that has tended to be where the best performance has come from for the risk that you take. Now, that's not really been the story for the full year, but if you go back to the a full century, to the rolling 10-year returns, and look at all the rolling 10-year returns across that, there were not that many instances where small cap value was not the best place to be. So if anyone's curious about their vulnerability to the downturn that we've seen recently in some of those big tech names, I can tell you that we're doing what we can within the US stock market to not have your exposure get too great in those seven big names, and that comes from us overweighting small cap value a little bit. Within international markets, value did better than growth, and small cap did better than large cap. So that's been terrific to see. Over longer periods, small cap and value have also done the best in those markets. And if you go back the last 10 years, it's been pretty even across that. But if you start to get back over longer time frames, you will see that small cap and value have outperformed. But it's good to have this international exposure. And over the last year, international equities have been some of the best parts of the market to invest in. And over the last 1 year, value stocks in international developed markets have been up almost 23%. That's higher than the US number. There's the shining star for the quarter, emerging markets, a terrific quarter, a bit of a growth rally, which has been more unusual in emerging markets. If you go back and look at the 5 and 10 year numbers, then you'll see that small cap has been a pretty good place to be, and value has been a pretty good place to be. But a little growth rally there in all great numbers. And for the first time in a while, the US dollar actually strengthened. So the returns for US investors, those that are depicted in the darker color of the bar chart, were a little bit less than the returns that occurred in the home currencies. So here's our fixed income slide. I think that's the one that always has the most data on it. And so there's a few things to look at here. I won't try to go through every piece of data. I'll just make a couple of points. One is that the Treasury yield curve in the top middle there is depicting in blue where interest rates were at the end of September. And what you'll see compared to where the curve was at 90 days ago and a year ago is that the curve is almost straight. One more drop in rates from the Fed on the short end of the curve, and it would be a pretty normal looking curve. And when I say normal in economics, that means that short term rates are lower and long term rates are higher. So it's as close to normal as we've seen it for quite some time. When you have a sharp kink in the curve, that usually just means that the Federal Reserve is lagging in its policy actions to catch up to where the market has already gone. And so we expect that curve to flatten out one way or another, although I will talk about some reasons that the Federal Reserve might not lower interest rates again this year. The other part of the slide that's worth looking at is the table at the bottom, and in dark gray is the line for the fixed income index. And as you can see for the 5-year return, not too productive there. There's been a lot of volatility in fixed income. In fact, in 2022, that index was down over 13%. We've tended to focus our investments in the rows that you see depicted in green, and that's because we found more stability there. And we take it as our mission to create stability and focus on capital preservation when we invest in fixed income in the public markets. We have plenty of more high returning, exciting, opportunistic investments that we can do without getting into equities, certainly including private fixed income, where in the next year I'd expect yields to be in the very high single digits and in some cases still into double digits versus what we're going to find in the public fixed income market. Now let's talk a little bit about history, and I want to start this look at history as a formation for what our market outlook will be by first talking about currencies. And there has been a lot of news in the financial press about currencies. And so let's look at the value of the US dollar over time and what's happened. And you might be a little bit surprised at the shape of this curve. This is the value of the US dollar relative to foreign currencies over the last 5 years. Now, if you go in and look at the headlines on any given day this year in the financial press, what you'll see is the falling dollar and the falling dollar, and how that's going to be evidence that that our currency is no longer the reserve currency of the world. And so much ink has been taken up, virtual ink, I guess, these days, writing that same story that the dollar is collapsing. And sure, for the last couple of years, the dollar has fallen significantly in value. But if you extend your time frame of analysis back just a few years more, what you'll see is that the dollar is still well above where it was 5 years ago. And so you gotta wonder about the agenda of folks that are writing that story, because yes, the dollar has weakened, and yes, it may have had something to do with tariffs and might have had something to do with the Federal Reserve versus other central banks. And there's a lot of stories to be told that might explain the changing currency valuations. But I think it's very premature to call it a collapse. And if you really want to know what to look at, you might even remind yourself of the fixed income slide that we were just looking at, because right now the Treasury can issue 30-year Treasury bonds all day long, paying about 4.7% is kind of the rate right now. And so if there is a robust market with trillions of dollars in trading going on that says 4.7% is good enough for 30 years, then the dollar is not collapsing. Now, if we all read headlines a year from now where we've seen the 30-year treasury go to 6%, 7%, 8%, and above that, then maybe that story will ring a little bit more true. But for right now, at least, yes, the dollar has lost some of its strength, but it's still above where it was just 5 years ago. So context matters. I want to talk now about inflation, and I'm going to start to get into this idea of history being rewritten here in a minute. But the main headline here is that sticky prices aren't falling anymore. And I think we're going to be able to explain why in the slides that follow this. But let me just remind everyone that there's the CPI, Consumer Price Index figure that you hear about, and that's the one in green on this slide, and that's the headline that is most closely related with the moving tax brackets each year. It's most closely related with the cost of living adjustment that Social Security uses, and so on and so on. There's slight variations in the CPI that are used for some of those calculations, but that's the one that you hear about. But there's another index measure that is my favorite, and that's called the sticky price inflation index. And that inflation index moves much, much more slowly. And the best way to think about it is that the CPI, very volatile, tends to drag the sticky inflation index in whatever direction it's going. And so you can see after the last recession, when the Fed kept interest rates at zero, that the CPI took off and it began to drag that sticky inflation index upwards. When the Fed finally caught up on their business and raised interest rates, CPI immediately began to fall. And then eventually, as it crossed through the sticky price index, it began to pull it downwards as well. Well, right now, they're at about the same level. So there's no suggestion out there that one is going to fall below the 2% target that the Federal Reserve likes to talk about. We may stay where we're at. Now, I'm going to suggest that this means the Federal Reserve is going to be very cautious about lowering interest rates from where we are right now. We thought we were going to get another rate decrease this year, and we might. But I'm having doubts more and more every day unless we get some inflation numbers that show it falling. With inflation kind of locking in at this rate and those two measures converging at above 2.5%, I think the Fed will be leery about dropping rates and potentially inciting a pickup of inflation, such as they did after the COVID recession. As a confirming indicator of inflation, let's see what's going on with commodities. Well, in the third quarter, you had the spot commodity index, which is a bit heavily weighted towards energy, up 3.65%. And in fact, the 1 year number is now up to 8.88%. So these prices move around quite a bit. But with commodity prices rising again, we can just look back at the last year and say, well, at 8.88%, that's a lot of pressure on producers that compromises their profit margins. And these producers, as much as possible, are going to push price increases onto consumers in order to protect their margins. And so commodities are a big input to the cost of production for all kinds of industries, and that can be a good indicator of what's to come for the CPI. Now let's talk about all the reasons that everything we just said about inflation could possibly be wrong. And this is getting into this idea of history being rewritten. Uh, there is a minor ability to adjust inflation figures, but for the most part, we expect inflation figures to be right. That may be about to change. We may be coming back later in this year and saying, no, inflation was a little bit different from what we thought. And the reason is that the Bureau of Labor Statistics is under a lot of pressure from a budgetary standpoint. Um, not just the political pressure, but budgetary pressure. And so they are having to rely more and more on what they call imputed data. And imputed data is not a direct measure of inflation. It's not a direct measure of the cost of the basket of goods in the CPI or CPIU bucket that we saw earlier, or the sticky inflation bucket. It's basically trying to fill in the blanks as best they can. And it's a bit of a last resort when you're a statistician trying to assess the rates of inflation. Well, with this use of imputed data skyrocketing here, I'm not sure I can believe the inflation data. Now, what that means for a statistician is that they think they know what the inflation number is. The Federal Reserve, the same way, they think they know what it is, but now they have to adjust for the idea that it could be meaningfully higher or meaningfully lower, which adds extra risk to their decision. And that may cause the Fed to become a bit more paralyzed and be even more concerned that perhaps inflation's running at 3%, and again, be slow to lower rates from here on out. This problem with the numbers has already happened in employment. And I'm going to speak about this for a couple of minutes here. There's a big lesson to be learned. Now, last quarter, I talked about how the prior year there had been a big adjustment to the employment numbers. And so when we were all together 90 days ago, we didn't have the last bar on this bar chart. We had the 2024 adjustment that happened at the end of August of 2024 that marked down substantially the number of jobs that were active in the US economy for the year ended March of 2024. Well, it's happened again. And at least last year, we were able to say this was not the biggest markdown ever. That happened during the great financial crisis, as you see to the left there with that red. But it's happened again, and now it's been the biggest adjustment ever. And so in the beginning of September of this year, we saw a markdown of the total number of US jobs for the year ended March of 2025. So this is lagging already when it looks back to mark down. It's marking down jobs 18 through 6 months prior. So there's a lag and it's going to be adjusted again. This level of error is unprecedented. And three of these stacked up on top of each other is a real reminder that we might not have the right data. So is inflation going to get this bad in terms of the inflation measures we're getting out of the government? Are we going to see these kinds of revisions? Well, let me tell you, this kind of revision in the labor market is a super big deal for the Federal Reserve. Just as they're loath to lower rates because inflation might be higher than they like, they're also going to be tempted to go the other direction and get rates much lower to stimulate employment, because the employment market, it turns out, was much, much weaker than we all thought. And I think of all the times over the last few years that I was encouraging our audience here to not worry about the possibility of a recession, because how could we have a recession with so many jobs being added? Eventually, it got to the point where I'd said publicly, I don't know where the people are coming from for this kind of growth in the employment market. The participation rate was as high as it could be. And it was a funny thing. We were getting all these anecdotal reports from young college graduates and others, older workers as well, saying they were having trouble finding a job. And we looked at these labor statistics and said, well, that can't be. We're adding so many jobs every month. This is just an amazing labor market for job seekers. Well, it turns out it was not. There was probably a higher risk of us going into a recession than any of us thought at the time. Turns out the labor market for the last 3 years has been considerably weaker than we thought. Now I'm going to show a chart with two different things on it. And I'm going to suggest that going back 3 years to that point with the line we just put up there marked a permanent, perhaps structural change in the way our economy works. So we see the performance of the S&P 500 with the dotted blue line. We also see job openings. Now that's how many jobs are open at any point in time. And we knew that that had begun to fall off a little bit, but it still seemed high. But now we've got corrected data in there. And so what began 3 years ago, almost to the day, well, certainly to the month, was a divergence. Because in the past, it always seemed to be the case that when we had a lot of job openings, or we had job openings moving up, it meant it was a super strong economy. Companies were hiring. So when job openings is going up, companies are looking for workers, desperate for workers. In some cases, it's a roaring economy. The stock market's going up. And those things tended to move together. But something happened 3 years ago. The stock market just kept on going and job openings began to drift down. And so if we think back to what we were talking about just a few minutes ago, what happened 3 years ago? In November of 2022, ChatGPT was released. And so I think when we begin to write the history of this era we're working in and investing in now, we may see that as the beginning of the erosion of the labor market where jobs are being replaced by AI. It's great for investors. If you're in the top half of the US economy where you actually own some stock market exposure, you're loving the fact that the stock market's been going up and riding this AI boom. If you're out there looking for a job, things are getting more and more dicey every day. We may continue to see the market move up and we may continue to see job openings drift down as we see more and more weakness. Now we're being forced to look at the anecdotal evidence, reports from recent college graduates, announcements by corporations that they're laying people off, right? Because we're not sure that the data we're getting out of the government is accurate. It may be that it takes another 18 months to figure out what the real numbers were. But looking back now, that seems like a big structural change, and that explains a lot about what's been going on in the labor market, and it raises a lot of questions about what the Federal Reserve is going to do going forward. One more confirming bit of data. I know folks would be curious. This is looking at job openings across a variety of different industries. The one that may really jump out at you here is software development jobs. Now, that's gone up and down, and that's gone up and down for decades. So that's not new. But when we're tracking it here, what we see is that the run up after the pandemic was terrific for folks in that field, and then jobs began to be shed at a very, very rapid pace, and the number of job openings right now is well below what it was at a year ago or certainly 2 years before. And maybe that job task is the canary in the coal mine for AI replacing human workers. What we can also see is that other job openings have been affected. Some folks might be surprised to see that construction job openings have been falling because we've probably all read the reports about the giant data centers that are being constructed everywhere. And while that's true, and that does put construction workers to work, it has not been enough to offset the weakness in commercial real estate, office space in particular, that seems to be at a bit over capacity and actually still under a fair amount of stress, even as the return to work policies have caused more workers to come back into the office. I'm not going to linger on this slide and read it to you, but you're going to have it in what we send out to everybody that's on this call here in a few days. But this is a great article written by Dimensional Fund Advisors, and some of you might see some DFA funds, as they're called, in your portfolio. But they wrote a great article to remind us all that there is no escaping AI. There's probably no escaping it in the job market, but there's no escaping it in the investment market. So if you indexed your portfolio right now in the US, you'd have about 30% in just seven stocks, and they all tend to be in that AI provider space that has us quite worried. But it's across global equities, not quite to the same degree, but there as well. So AI tools are touching everywhere. I think as we go forward, we're all going to become much more familiar with this dichotomy in the AI market about the AI providers, as we talked about, and the AI users, which is everybody else. But you could do almost anything in an investment portfolio right now in the public stock market, and not be able to avoid AI to some degree. And I think if we begin to see this rotation into the AI users, that could provide broad-based lift to the parts of the market that have been a little bit left out with this tech AI provider boom. Just a few disclosures for you to read in your spare time. Now let's wrap up here. As we said, the performance of the public stock market has been fantastic, better than we had any right to expect, which always becomes concerning as you see that potential bubble continue to get extended. What I want to remind people is this: if you're going to have the best investment performance, it's probably dependent upon buying low and selling high. And unfortunately, sometimes that may require that you pay a little bit in taxes. And so, if there's any folks listening to this call that have suggested to their advisor, I don't want to trim an equity portfolio, I just want to let it run. My financial plan may say I need to be 60% in equities, but I'm going to stretch it to 70. You know, there's always a time where you can look back and wish you had sold a little bit more. Maybe now is that time, but I don't think it's unreasonable to pay a little bit of a tax bill to keep the risk at your risk budget with your financial plan. Once again, we're talking about AI. That is something that's probably not going to change. But as I was just reiterating, there is a difference between AI providers and AI users, which I think is going to be just about everybody. Lastly, as we focused on quite a bit here, history is not what it used to be. I think that's going to create a level of uncertainty around policy, a level of uncertainty around what is actually going on in the economy that we haven't had to face before. We talk about it in China. We talk about it in other emerging markets. How you can't always get good data, and you shouldn't trust what you do here. I didn't think I'd be saying that about the U.S., but that seems to be the world that we're living in right now. So it just, I think, increases the risk that anything could happen. We could get more data revised. We could get inflation data revised in the future. Probably really putting the Federal Reserve on the spot to take some quick and unexpected action in response to that data. So again, a great time to focus on your financial plan, the amount of risk that you can actually sustain, and if there's more non-equity investments that you could add to your portfolio that might actually improve your return and lower your risk. Again, maybe private credit is a good example for a lot of folks on this call. I'd encourage you to have that conversation with your advisor to see if you can make sure and make the necessary moves so that you can go into 2026 with confidence.
Good. Thank you, Eric. Eric, I'll start off with a question. Let's talk about the government shutdown and opening back up, and any context or perspective that you would like to give on that.
Well, it does appear that we're open back up, at least for now, although that is not an indefinite state of affairs. As we get into early 2026, some of those battles are going to be fought again. Related to that, news that was coming out right as the government was reopening is also some other news. It would appear that the Supreme Court might be about to reverse a lot of the tariffs that were imposed, which would be require the federal government to refund $1 trillion. And I don't know how that kind of budgetary impact bill is going to factor into the next set of budget battles that might be coming in January, because all that could be happening at about the same time. So there was a lot of drama here, but there might be even more drama in early 2026. Also, just want to mention, while we're talking about the government, there was some very interesting news that came out about the possibility of 50-year mortgages. And someone might have some questions about that, but I'm going to jump in anyway, because we're talking about government policy now. I'm not so sure it's a great idea, but there's two hidden pieces of news about that, and I want to make sure our audience gets to hear about that. I'm not sure if 50-year mortgage is a great thing, but it could be, and here's why. There's two other changes to mortgages that have been proposed. One is that conforming mortgages, which is the ones that Fannie Mae and Freddie Mac get behind, could become assumable. So you sell your house and the buyer can take over your mortgage. So if you've locked in at 2.9% with your mortgage, but the buyer is going to have to go get a mortgage at 7%, if they could assume your mortgage, then that could be a flood of inventory coming onto the market for housing and bringing housing costs down. That would be a big deflationary impact. The other potential policy change for conforming mortgages was that they be transferable. So not just assumable, but you could take your mortgage with you when you buy a new house. So you've got the 2.9%, you take it with you, and you've got the same 2.9% in the new house that you buy. Like, wouldn't that be crazy? And there's a few places in the country or in the world that let some of that happen now, but that would be an absolute game changer. In other words, our new advice could be, if this happens, hey, if we ever get interest rates on a mortgage back down to 2.9%, all of our clients should go take out 50-year mortgages, because there's nothing better to beat inflation than owing somebody else a lot of money at a very low interest rate, right? That could be a great financial planning move. So the whole world of financial planning and how all that works could be about to change. I just wanted to throw that in. Again, that's not exactly related to the question, but if we're talking about government policy, things could be about to get very interesting.
Good. Thank you, Eric. All right. We do have some questions that have come in. First question is, what percent of our U.S. equity exposure is in the Mag 7, the Magnificent Seven, compared to the percentage of those seven companies that are in the S&P 500?
So we say that there's about 30% of the U.S. stock market is in the Mag 7, and the S&P 500 is about 85 to 90% of the U.S. stock market. So the S&P 500, the total U.S. stock market, the answers aren't all that different. About a third is in the Mag 7. Now, I will just say that we changed that a little bit for our investors here. So when we say our U.S. equity exposure, again, it's going to be a little bit more like 20 to 25% because we overweight small cap stocks a bit. We also overweight value stocks a bit, which gets you a little bit away from those seven. So we're not avoiding it altogether. And so we're participating in the rally, but we've certainly seen on those days like yesterday, there was a big the last week, the last month has been actually a value rally, even as the total stock markets come under pressure. That does insulate us a little bit from that. But the other thing that we do, of course, is we invest overseas. It's been a great place to be this year. And then, the third big thing that we do for, when you say our equity exposure, is that, an awful lot of our clients have exposure to private markets that in many cases are those big AI users, right, that are finding great increases in value and productivity through using AI. So there's really three different levels of what we do to mitigate that risk of the big seven.
Good. Thank you. Next question from Quentin on the fixed income market slide. What does ICE Bank of America stand for?
So we're often looking at indexes out there that are created by for-profit companies, and B of A, or BOFA as it's sometimes called, is in fact Bank of America. And there's this whole series of indexes called the ICE Bank of America that are out there. And there's a company called ICE Data Services. And I don't recall what the original ICE stood for, but it's a company name. So ICE is a company, Bank of America is a company, and they run a series of indexes just like the fixed income index, the AG used to be the Lehman Brothers AG. Remember Lehman Brothers? Of course, they're gone now. And then it was the Bloomberg Barclays AG, and now it's the Bloomberg AG. So this index business is a big business. And so there's all these companies that are out there that are running these indexes, and that's just a reference to the for-profit company. And they generate quite a bit of revenue in the financial industry, tracking that and providing that index data to investors.
Good. Will has a good question here. Looking at slide 20, does the BLS data on jobs jive or correspond to the ADP data on payroll? Are there better data points to look at for our job numbers?
Well, it's a funny thing in this business, and I've been looking at this for decades. We would get the ADP data, and they're a big payroll provider, right? So ADP has their data, but that's not every company. So we get the ADP data. It's, oh, that's interesting. And then we would wait for the government data because that was the comprehensive data. That was the accurate and real data. So ADP was a bit of an indicator of what was to come from the Bureau of Labor Statistics. Well, now that we don't think that we can trust what's coming out of the Bureau of Labor Statistics, and this is a problem that's been out there for quite some time, crossing both the last two administrations, we're paying a little bit more attention to the ADP data. So again, their clients are not a perfectly representative sample of the U.S. economy, but we're paying a little bit more attention to that. We're paying a little bit more attention to layoff announcements. We're paying a little bit more attention to, reports, as I said, from the new college graduates, all of which you could lump into the category of being anecdotal. But of course, the ADP data is the most professional of all that. So I would say that ADP's importance in that field just went way up, right, with all these doubts about the BLS data.
Good deal. Next question. This is a good one. If you think we might be in a bubble, should we be saving cash to invest when the bubble bursts, or do you think non-equity investments such as private credit are a better solution?
What a great question. And let me frame it this way. Maybe we're in a bubble, maybe we're not. But if you're worried that we are and you're over your public equity risk budget, of course, the first thing that you want to do is take some profits, pay a little bit in taxes if you have to. That then raises the question, what do you do with the proceeds? Well, we could go put it into public fixed income and be, somewhere in the 3 to 4 to 5% range. Maybe you put it in our short-term tactical or treasury strategy, which is always going to tend to do better than cash. Let's say in the next 12 months, the outlook there is in the 3 to 4% range, but not even exposed to the vagaries of the broader public stock market, pretty much locked in at that rate, right? Treasuries are pretty darn safe. We've got clients with millions there rather than leave that in a bank and be over their FDIC exposure. So those are two ways to go. But we have a carefully curated selection of private credit providers, one of which doesn't even require that you be an accredited investor, which always was a bit of a barrier for some of our clients. And we're looking at yields there being in the very high single digits to low double-digit percentage yield for the year. So let's just say that you took some equity profits, paid your taxes, took your net proceeds, and we're going to put it somewhere. Would you rather be making 3 to 4%, or would you rather be making 9 to 10%? Well, the answer might come down to, could you go get that money if you wanted to suddenly jump in after a big market decline? And we like it when our clients reach out after a big market decline and ask us, is now the time to jump back in? So you've got a little bit of a liquidity problem there. Now, a lot of the private credit strategies that we use will allow you to submit to get your liquidity out of those on a quarterly basis. So maybe splitting the difference between the short-term tactical treasury strategy and private credit is the answer. But when one of them is paying 6 to 7% more than the other, you're being paid to wait. And even if you miss the bottom in a downturn of the equity markets, if you're making 9 to 10%, or maybe even a little bit better than that, that's not such a penalty. In fact, if you're making 9 to 10% in private credit, that's more than we think you'll make in the long run in the stock market. We have that at 8 to 9. So, that could be a permanent strategy rather than just a place to park it and wait to do something else.
And Eric, as a follow-on question to that, I mean, you're not saying just because we may be in a bubble on the technology stocks that you would just go sell all of them at this point and re-diversify or anything like that. How do you address that?
Sure. I will get the question from time to time, though, what do I need the stock market for if my private credit's going to make me the same or higher yield? Of course, the stock market tends to be way more tax efficient if you've got this in a taxable account. But it does raise that is a legitimate question. Now, what I'd say is the best way to answer this is to go through a financial planning analysis with your advisor, and we can model some of this. In general, without any consideration of tax consequences and so on, what I'd say is that our long-term expectation for public equities is an 8 to 9% return with a lot of volatility. Markets go up and down. It's great when they're going up. It's not so fun when they're going down. We expect private credit to earn a little bit higher than that and to, generally speaking, be a pretty smooth path. So at a minimum, if you're an investor that doesn't have much private credit exposure, there might be at least a partial shift out of equities to that private credit exposure. And again, for many of our clients, because they've got a low cost basis in their existing exposure, they're in a high tax bracket. And if you're in the highest tax bracket and you got private credit in a taxable account, you might be making 10, but giving 4.5 of that to the government in taxes, right? So there's some big reasons that are very individual to not make a wholesale move, as we would say. But most client portfolios that I look at could benefit from more private credit exposure.
Here's a follow-up question we've received regarding private credit. So if another 2008 happened, which was the Great Recession, do you think private credit would be hit harder than public fixed income? And would the leverage involved make that decline worse?
So if I'm going to speak about the broadest possible category of private credit, what I'll say is that there are strategies out there that are loaded with risk. One of the providers that we use, and again, we've got 5 choices right now that we can use to build your private credit portfolio. 5 different managers, 5 different distinct strategies. I love it when I see a client that's got all 5. But they are selected as being the safest of the safe as far as we can determine. And one of those describes it this way. They say there's more than 300 private credit strategies out there in the market right now. 200 of them they wouldn't touch. They're loaded with risk. Their fees are excessive. There's all sorts of problems. They're worried about the downturn too. As an example, there are some what are called BDCs, but they're public BDCs that I follow that are down more than 25% in 2025. They're really getting hurt. And that's the reason for all the negative articles that you're reading in the Wall Street Journal and CNBC and elsewhere. But it's a big category, and the devil is in the details. At the safest end of things, at the absolute safest end of things, is what we call senior secured debt, where it's the most senior obligation of a company that borrowed the money. And in particular, it's safe if that's a company that also has a private equity sponsor that could be compelled to put cash on their balance sheet if their financial metrics begin to slip. And so you've got kind of a double level of insurance there. It can, in many cases, be safer than much of what you can buy in public fixed income. Now, I'll say treasuries are the safest thing I know of in the world, and that's why we have a whole strategy built around that. But the ag was down 13% in 2022, and we've never seen the safe end of private credit do that. In fact, in many cases, we've rarely seen strategies ever even go negative at all. So I think the devil's in the details, and our mission within private credit is, for the most part, to focus on the absolute safest end of things, knowing that we've got a little bit of opportunity there to do some asset-based lending. We've got a little bit of an opportunity there to do some covenant-rich venture debt investing to get some returns that have tended to be a little bit higher, but in very specific, well-vetted ways. So I expect that in the next 12 months, we're all going to read a bunch of headlines that are highly negative around private credit. You might call your advisor and say, oh my gosh, what's going on? About okay. And the answer is likely to be, no, you're fine. You're doing great, because we took those steps ahead of time to be very careful about where we put the money.
Good. We have a couple more questions
Sure.
and a couple more minutes, so we're good here. Lee asked the question, can you say more about the divergence between the stock market and the job openings, and what impact that trend could have on the health of the U.S. economy 5 years from now or even 10 years from now?
Thank you, Lee. Great to see you on the call today. I think that trend could very well continue. We didn't realize it had started in such a prominent way 3 years ago until the data got revised. But I think it could continue. And if it does, here's what it's going to mean. The U.S. more than ever before is going to be divided into 2 parts. There's the folks that have a stock market portfolio, a private credit portfolio, all these great things that we've been talking about, and they're going to benefit. They're going to continue to benefit in the way they've always benefited, but we could see this decline in job openings not just impact the lower economic classes, but the middle class as well. And so we talk about half of Americans not even owning a share of stock. I think that if this trend continues, and there's a decent likelihood it will, we will see in America more and more and more divided along socioeconomic lines. If you do not have a portfolio that can benefit from what the markets are doing, then you don't have a very good hedge against what could be about to happen in the labor market. It's back to the fears that we all began to wonder about 3 years ago when AI really burst onto the scene. How many jobs is it going to take? How many people are simply going to have nothing to do? Now, I'd say the economic consequences of that are not even as big a deal as the political consequences of that. Economically, we already know that the top 10% of Americans are responsible for close to half of all the consumer consumption that goes on in the country. So the economy, to some degree, tends to do okay as long as the top most wealthy Americans are doing okay. But if it begins to take out the middle class or even the professional class, that's a different story. And then, boy, we need another hour to talk about the political ramifications that could come about from that.
We'll give you another hour on that another time,
All right.
Eric. So, all right, last questions from Will. Can you talk a little more about home ownership? Is this still a good time to own a home? Will home values continue to run and go up in 2026? Recent reports show first-time homeowners are averaging about 40 years old.
Yeah, it's funny. There's been two trends that have moved kind of in lockstep. The age of first home ownership and the age of first child being born have been older and older and older and older. The first child being born is not quite up to 40, but home ownership is moving to that. And I'm reminded of back before the great financial crisis, when the mantra out of the White House that seemed so reasonable at the time was that we wanted to embrace a new level of what we call the ownership society. Because, if you look at poor Americans, they don't own a home. They don't have any stocks. They don't own a home. They pay for everything. They rent everything. As you get into the middle class, the home is the biggest asset on someone's balance sheet. As you get beyond that, it's financial assets. It's not the home anymore that's the biggest part of someone's balance sheet. But squarely in the middle is owning a home. And so this embrace of the ownership society to push people into homes, to loosen underwriting standards and all that, of course, backfired in a horrible way. And one of the conclusions you could take from that is that the natural rate of home ownership in this country is not going to be above 70%. It's not going to be 80%. It's going to be closer to 60%. That 60% is just kind of the number, somewhere between 60 to 65. That's normal and supportable. So I think for most Americans, but a little more than half, home ownership makes sense. But the market probably got a little bit ahead of itself. The market is cracking. In more than half of states, home prices are falling. If you have a first home or a vacation home in Florida right now, I'm sure you know exactly what I'm talking about, because there's very few areas in Florida that are not getting hit really hard with significant price declines in homes. So in some ways, homes are becoming a little bit more affordable. At the same time, rents are actually starting to come down as well. So I think the market got a little bit ahead of itself, and maybe some of these rules about transferability and assumability of mortgages could sort of loosen that up. And if you own a home, you might see the price fall, but it might be about to get a lot more affordable because of now a lot more inventory will come onto the market with these regulatory changes. Again, kind of independent of the whole 50-year rule. So a lot is about to happen potentially in the home ownership market. But I don't think that, generally speaking, home values are going to continue to run in 2026. But, what is it they say about real estate? The three most important things are location, location, location. So if you live near great schools, you got sidewalks on both sides of the street, you sort of find that ideal, you probably don't have too much to worry about. If you're in an area where there's a lot of second home ownership near a coast, something like that, you probably do have a lot to worry about.
Good deal. Thank you, Eric. And thank you for the questions. I think probably the questions were even more informative and more interesting than maybe even the presentation. So thank you, everyone, for chiming in on that. And I hope everybody has a fantastic rest of your day and have a great weekend. Thank you very much for joining us today.
Thanks, everyone.